Hi friends, it's Devin, founder and CEO of Choules Financial. We're going to go through the 5 things that you need to know about RMDs, required minimum distributions. First thing is we're going to learn about what are RMDs. Required minimum distributions, or RMDs, is a required payment or amount that you have to take out of your pre-tax accounts at a certain age. Now, the government, they used to have it at 70 and a half, and then they changed it to 72, and now it's 73. And the good news is it's a graduating scale until it gets to 75, and so now nobody knows what they're supposed to do, but that's what we're here for. With your RMDs, things that we need to be aware of and why we need to take them is, so for these payments that we have to take out, the government tells you that when you reach 73 right now, whether you need the money or not, you must take a distribution. If you don't, they will give you a 25% penalty. 25% on top of the taxes. So we never want to miss them. So this is why this week's educational bit is on RMDs, what we can do about them, and all the moving pieces. With that, which accounts require an RMD? I already kind of gave that away, but all of our pre-tax accounts. What are some pre-tax accounts that require distributions? Things like our 401ks, 403bs, 457s, TSP, 401a, IRA. All of those, when you hit 73, are going to force you to take the money out, whether you need it to spend or not. The government, you've never given them any tax dollars on it, and they want their pound of flesh. So inside of that, we want to make sure that we know which accounts, and then inside of that as well is, how do we calculate? We learned that we do have to take money at 73. We learned which accounts we have to take from. Now we need to learn how much we have to take out. Now the government, in their infinite wisdom, instead of just saying, hey, at 73, you need to take out 3.879%, or I'll just call it 4 to keep it simple. They gave us a table of lifetime expectancy. You have to do some math. The good news is when you work with a professional, we know the math, we'll get it taken care of for you. So it's not a big deal there. And the biggest confusion that comes with how much is when people have multiple accounts in the pre-tax bucket that qualify. They may have 100,000 in one account and 100,000 in another. And they think, oh, I've got to take 4% from here and I got to take 4% from here. So I've got to take $8,000 or $4,000 from each one of these. But in all reality, they don't care how you do it. They just want you to do the math and say, you have $200,000. We don't care if you take it all from one account, from 2 accounts, from 10 accounts, as long as you pay your taxes. Because that's the whole purpose of the RMD, is to get that money out of your account and give them revenue. Don't worry about it. It's pretty easy. All we need to know is all of your pre-tax accounts, calculate them up, and then decide which account we take from and why. Next portion we're going to go through is 4. How do we take it out? Do we take it out in installments or lump sum? There really is no strategic piece here that I find value in. Some people may say, well, if you take it out in lump sum at the end of the year, it could grow all year long. Some people will say, well, if you take it out in installments, you leave a little bit more in there every year so it can continue to make more as it goes all the way through. Really, when it comes down to it, we talk about Choules Financial, about living a life of yes and what that means. To me, we want to make foreign things familiar. An RMD is a foreign thing to you, but getting a paycheck is not. You spent your entire working life taking out money and getting it either at the beginning of the month or twice a month or every week, depending on how you were paid. I like installment because it resembles everything we've ever known. So to me, whether there's a strategy, if I can get more here, do this, do that, biggest piece that I want to do for you guys is, if you have to take it and you're going to live on it, we want to take it and make foreign things familiar and make it very normal to you, knowing that on the first of the month, X amount of dollars is going to show up in your account. How can RMDs impact Social Security? Now, a lot of people don't know this. Again, the government makes everything so simple. Just like the calculation tables for your RMDs, when it comes to your Social Security, something that is unique is that it takes an entire page calculation, literally an entire page of if this, then this, to determine whether or not your Social Security is taxable. And what I see far too often, even in my parents' case, that they're able to live on their Social Security and take a little bit out of their accounts to live on throughout their life and really be relatively tax-free because their Social Security isn't taxable. But now that they're hitting the age where they're required to take their RMD, it's changing the entire scenario Because now when they're forced to take that bigger chunk out, not only do they have to pay taxes on that amount, but the unintended consequences is it's making this money over here from the Social Security that was potentially not taxable before, now taxable. This is why so much of when we talk about the 5 worlds, the 5 areas you have to have for a complete retirement plan of your investments, your income, your taxes, your healthcare, your legacy. When it comes to your tax planning, having a proactive plan really matters of how can you set yourself up for success, and maybe in a way that you don't have to have your Social Security taxable for the rest of your life because we had a proactive plan. Now, there are other ways to help reduce that. Something that everybody who's charitable should, once you hit the age of 70 and a half, so many numbers, so many different pieces, now we have half birthdays, but there's something called a qualified charitable distribution, or a QCD. Inside of this, what it allows you to do is to be able to gift money to a charity and not have to claim that as taxes. Now, far too often I'll have discussions, I'll put it that way, with people that they'll tell me, well, I save my tithing or I save my donations so that I can make them all in 1 year and then I can claim the standard deduction. Look, folks, that works. That's a great strategy until you hit 70 and a half. When you guys come in, we can walk through it of the why and the how. But I promise you this, if you are charitably minded at all, period, and you are of the age of 70 and a half, you should always be giving away money in a qualified charitable distribution from your pre-tax accounts. All right, folks, that's this week's version of the Key to Yes. If you have questions about your RMDs, if you have questions about, is my Social Security going to be taxable because of my RMDs, things like that, you know where to find us. Schedule an appointment, come in. And as always, make sure that you click down below, get the notification button, and make sure you hit the subscribe as well. And we'll see you next week.